This is our Forex currency blog for April 4th, 2011. And like most days, you really want to trade the strongest currencies against the weakest. Our currency meter shows the real-time strength or weakness. Anything at or above the dotted 80 line is extreme strength or weakness. And usually those trends, will continue, sometimes for up to 3 or 4 hours. Underneath that, we have the statistical daily, weekly, and monthly trend of each individual currency. So the dollar and the yen are both weak. If you see weakness show up today in the yen or the dollar, you want to trade it against one of the stronger pairs. Euro, very strong. The New Zealand, across the board, daily, weekly, monthly trend strong. Pound has a weekly trend that's up. The monthly trend's down. The daily is just slightly up. But if you see extreme strength like you did today in the pound, the dollar, was the weakest during that time. You could have also looked for, sells in the, buys in the pound yen. Right before midnight, and again right here. Once the yen became strong, you would have, rather looked and waited for the dollar weakness or strength to disappear, and hopefully the previous weakness to resume, which did somewhat up until 6. So before midnight, up until maybe about 3, you'd be looking to trade and buy the pound dollar. So here's the pound dollar chart. You can see it's above the hourly moving average. It exploded up on Friday, kind of went sideways, broke out of this narrow rectangle range and went up about 50 pips right to our upper band. Most of the time the upper containment band is where the price is going to stall and reverse, especially when you don't have extreme strength. Anything underneath the dotted 20 line is, it's not likely to go through the upper containment band, especially when it made a slightly higher high with half the mediocre strength that it had before. You want to get out of your trade. And anytime a currency explodes up and hits the upper band, the first time and usually second time it pulls back and hits the hourly moving average, which is this gray middle line right here, that's usually a pretty high probability trade, especially if it pulls back without that much weakness. So you got into that trade here, and you can see from 4 to about 7:30 it went up. From 4 to 7:30, actually the dollar was strong too, but the pound was actually stronger. So really a better trade was wait for some of this strength to disappear here a little bit after 5, and from 5 onward really look for that pair to be going up. Yeah, so here's actually a little bit after 5 right here. 5, the dollar's strength started to disappear, and that's coincided with this nice little 35-40 pip move up. The euro, again, also very strong daily, weekly, monthly trend. It had a little bit of weakness before, and then some strength coming in at 5:30. From 5:30 on, the euro was really strong, but unfortunately the dollar was also strong. You're better off when you see a strong, euro traded against one of the currencies that's weak. Today, the weakest and consistently weakest was the CAD. Euro CAD would have been one of the highest probability trades, going on that time, and you can see it broke out from below to above the hourly moving average and went up about 60 pips straight up. No pullbacks whatsoever, because the CAD was extremely weak. In the euro, not only the real-time strength, but the daily, weekly, monthly trend, was extremely strong. And this is the kind of trends you get when you buy the strongest ones versus the weakest. Now another currency that had incredible strength today, but the longer term trend slightly down, is the Swiss. Extreme strength today, extreme weakness in the CAD. Ideally you want to trade ones where the weekly, monthly trend match up with it. But again, the CAD Swiss is very likely to go down. Weak CAD, strong Swiss. And of course it does. And prices underneath the hourly, it's kind of chopping around, going sideways. Anytime you see a rectangle pattern for multiple hours that breaks down, especially underneath major support or resistance areas like the monthly pivot, very high probability trade, and it fell about 75 pips straight. Notice where it stopped, right at the lower containment band too. Even though the trend was nice and smooth, we didn't have off the charts intensity. Currencies that go above the upper containment band usually pull back. Same thing with below the lower band. Another currency that was extremely weak today, but the weekly, monthly trend was up, was the Australian. You could have traded the Australian Swiss short. Not pairs today normally that most people trade. Again, one of our filters is underneath the hourly moving average, look for sells. This one also kind of went sideways in a very tight 25 pip range, broke down right here, and the Swiss was strong and the Australian was weak, and you got this nice little 50 pip explosion to the downside. Now, if you were wanting to trade some of the main pairs, you can see they're pretty choppy today. If the currency's daily, weekly, monthly trends up and price breaks from underneath above the hourly, that's not too bad of a trade. It only went up 225 pips, right to the monthly high, it looks like. None of these really exploded up to any support resistance areas. I draw the fibs on the chart every night for our mentor students, and none of those fib levels in these main pairs, it appears, got hit. Here's another good example of once a currency is trending down, when it comes up to the hourly, usually it's a pretty decent place to sell it. Daily, weekly, monthly trends down, pretty high probability trade. If you see markets falling today with very little momentum, don't be greedy, draw your fibs on there. Really consider getting out. Notice the first one hit, got a little bit of a bounce, second one hit almost to the pip, and got a big bounce. So don't be greedy on dull days like this. Use your fib targets. Most of the time that's the maximum you're going to get. Now this one, the weekly and monthly trends down, went from underneath above the hourly. This is one of the reasons why we have that rule. Once a currency is above the hourly, it's more likely to go up. If a weekly and monthly trends down, I wouldn't necessarily buy this as it breaks from underneath above it. But once it pulls back and finds buyers here at the hourly, it becomes a relatively safe buy right here. This would be your first profit target, and this would be your second. If you're trading against the longer term trend, usually they don't move up more than one or two resistance areas. So I would have, looked to get out of the trade right here at 66. But that's about a 35 plus pip move, confirmed. Anytime a support level or resistance level, in this case the hourly, coming up to it, there's likely to be selling. There wasn't, which is a big sign it's likely to go up. When it pulls back and there's clearly buyers there, very high probability trade. And notice it went almost to the pip to our upper containment band. The longer term trend's down, so don't be greedy. If you stuck with it, that's a good place to get out. This one was so weak that when it broke the hourly, never even returned to it, which means, when this support level here got broken, it's very likely to go down to the next area. And again, the longer term trend's up, so don't be greedy. Draw your fibs off the previous wave. If you don't see a lot of momentum today, usually the first or second fib target's the most you're going to get. Today's the day really where our enhanced scalping tools would allow you to be able to grab 5-15 pip moves out of these very dull sideways action days. Another good example, broke the hourly, came back up, couldn't break it, went down. Same thing again here. Notice the longer term trend's up, so don't be greedy. Again, draw your fibs. Most of the time the fib targets are going to be where, look, almost to the pip. Counter trend buy signal right to the pip. This one did have more momentum to the downside than most of the other ones, which confirms the hourly is likely to be resistance area. Also, if you draw a fib on the whole wave down, it was a 38% retracement. We had a monthly pivot level, weekly pivot level right here. Major resistance right there, and as it was going up, the momentum kind of slowed down as it hit the hourly. Not bad for a 20-25 pip, trend trade. Here's one that once it broke the hourly, came back up to it. If you got short right here, notice it immediately reversed right above here, and you get out of your trade with a small loss. The losses, the only secret to trading really, other than the precise or increased precision timing tools that we've developed, is when you're wrong, get out with a super tiny loss. This is an example of one that broke, came back up and tested it. When it broke down, the trend, went down. So when they don't work, you lose 5-10 pips, and when they do work, in this case, and you saw many other, the majority of the times it did work. Let's say you're short here at 30, this trade right here at 11, you made 20 pips, and you might have made even more than that because I estimated down on our entry price and up on our exit level. It's about a 30 pip move down. Here's one that broke the hourly when it came back up. It did pull back about 15 pips. And what I usually do is once it moves 7 or 8 pips my way, move my stop down in half. 10 or 12 pips my way, move my stop to break even. So, most of the time they go enough your way that you can, lessen your risk. Here's another good example of once the currency broke the hourly and came back up and tested it. It didn't go above it, so you go short. This trend, pretty much fell 50 pips. Now, the only downside of this is it's going against the longer term trend, but many of these currencies have been up 3, 4, 5 days in a row. So, if that's the case, using our FX total view, you might want to, hang on a little bit longer. FX total view is given to all of our mentor students, and it really gives you a lot of information. There's a lot of pairs, especially the Australian, New Zealand pairs, and most of the yen pairs that have just exploded up 4, 5, 6, 7 days or more in a row. That's usually not the norm. Most days after 4+ days up, you can aggressively look to do counter trend trades at the high. But obviously the Japanese earthquake was a fundamental shift, and traders are selling the yen. Does anyone have any other questions on